What if everything you believed about silver's breakout was a carefully constructed illusion, and the real awakening is happening right now as the price falls? Today, December 14th, 2025, silver closed at $62.09 per ounce, down 3.87% from yesterday's $64.59. The mainstream financial media is calling it a correction. The perma bulls are calling it a buying opportunity. But what if I told you this isn't a dip? What if this is the red pill moment, the instant when Neo sees the code behind the matrix and realizes the world he thought was real is nothing but green symbols cascading down a black screen? Because what's happening right now in the silver market isn't a simple price movement, it's a revelation. And like all revelations, it's uncomfortable, disorienting, and absolutely necessary. Let me take you back to Wednesday, December 11th, 2025. Silver hit an intraday high of $64.85. The internet exploded. YouTube channels with names like Silver Patriot and Metal Militia declared victory. The banks have surrendered, they said. The suppression is over. We're going to $100, maybe $200. Hold the line. The squeeze is happening. For 48 hours, it felt like the prophecy was coming true. Retail investors who'd been stacking silver eagles in their basements since 2020 finally saw vindication. The COMEX was going to break. JP Morgan was going to collapse. The dollar was finished. And then reality knocked. December 12th, silver pulled back to $63.22. December 13th, it dropped to $64.59. Today, December 14th, we're at $62.09. In 3 days, we've given back $2.76, or 4.26% from the peak. Now, before you click away thinking this is just another bearish hit piece, understand something. I'm not here to tell you silver is going to zero. I'm not here to defend the Federal Reserve or the bullion banks. I'm here to pull back the curtain on the most sophisticated game being played in financial markets right now, a game where both the bulls and the bears are being used as pawns, and the real players are operating on a level most people can't even see. The Matrix wasn't just a movie about virtual reality. It was a movie about control through illusion. The machines didn't need to physically restrain humanity. They just needed to make people believe the simulation was real. And that's exactly what's happening in the silver market. But the illusion isn't what you think it is. Let's start with the paper market, the thing everyone loves to hate. As of December 2025, the COMEX has approximately 200 to 250 paper contracts for every single ounce of registered physical silver in its vaults. Registered silver is the metal that's actually available for delivery if someone stands for delivery on a futures contract. Right now, that number sits at around 130 million ounces, give or take, depending on daily fluctuations. Meanwhile, open interest in silver futures represents obligations for over 26 billion ounces. Do the math. The leverage ratio is insane. This is the fact that silver bugs have been screaming about for years. And they're right. The paper market is a house of cards. It's a fractional reserve system applied to commodities. If even a small percentage of contract holders demanded physical delivery simultaneously, the system would implode. But here's where the red pill gets bitter. That implosion isn't coming the way everyone thinks it will, because the system isn't designed to deliver. It's designed to settle in cash. And more importantly, it's designed to keep you focused on the paper price while the physical metal moves through entirely different channels at entirely different prices. Let me explain what's actually happening right now and why today's drop to $62.09 is more revealing than last week's spike to $64.85. In the last 6 months of 2025, something extraordinary occurred in the COMEX warehouses. From June through November, registered silver inventories dropped from roughly 180 million ounces to 130 million ounces. That's a decline of 50 million ounces, or about 28%. During the same period, eligible silver, which is metal stored in COMEX vaults but not available for delivery, increased slightly. What does this tell us? It tells us that physical metal is being removed from the delivery system and reclassified or withdrawn entirely. This is not a sign of abundance. This is a sign of tightness. But it gets stranger. In early November 2025, JP Morgan, the bank that's been accused of manipulating silver prices for decades, quietly flipped from a net short position to a net long position in silver futures. This information comes from the Commitment of Traders reports published by the Commodity Futures Trading Commission every Friday. For years, JP Morgan and other commercial banks held massive short positions, betting against rising silver prices. Critics called it suppression. The banks called it hedging. But in November, JP Morgan's positioning shifted dramatically. They're now long approximately 750 million ounces in futures equivalent. That's more than 5 times the entire registered COMEX inventory. Think about what this means. The biggest player in the silver market, the entity with more information and more capital than any retail investor could dream of, has switched sides. They're no longer betting on silver going down. They're betting on it going up, or at least staying elevated. So why is the price dropping today? Why did we fall from $64.85 to $62.09 if the smart money is long? Because the game isn't about the spot price anymore. The game is about accumulation versus distribution. Let me paint you a picture. Imagine you're JP Morgan. You've spent the last decade shorting silver, keeping the price suppressed while you accumulated physical metal at bargain prices. Reports suggest JP Morgan holds somewhere between 800 million and 1 billion ounces of physical silver in private storage. These numbers are unverified, based on estimates from researchers analyzing import data, refinery flows, and warehouse movements. But even if the real number is half that, it's still staggering. Now you're ready to let the price run. But you don't want it to run too fast because you're still buying. You want volatility. You want spikes and crashes. You want retail investors to panic sell on dips so you can buy their metal cheaply. You want industrial users to panic buy on spikes so you can sell them futures contracts at inflated prices, which you'll settle in cash when the price inevitably corrects. This is the matrix. The price on your screen, the $62.09 you see today, is not the real price of silver. It's the price of a derivative, a promise, a ledger entry. The real price of silver is being determined in private negotiations between mining companies and manufacturers, between sovereign wealth funds and refineries, between parties who will never report their transactions to the public. Let's talk about industrial demand, because this is where the story gets truly fascinating. In 2025, global silver demand reached an all-time high of approximately 1.2 billion ounces. This number comes from the Silver Institute's preliminary estimates released in November. Meanwhile, global mine production sits at around 830 million ounces annually. That's a deficit of 370 million ounces per year. For context, that deficit is nearly 3 times the entire registered COMEX inventory. So where's the missing metal coming from? Recycling accounts for some of it, maybe 180 million ounces. That still leaves a gap of 190 million ounces that's being filled by above-ground stocks, investment holdings, and existing inventories being drawn down. Now, here's the critical part. Of that 1.2 billion ounces of demand, roughly 220 million ounces went to photovoltaic solar applications. This is a 15% increase from 2024. The European Union alone has committed to installing 600 gigawatts of solar capacity by 2030 as part of its Green Deal initiative. Every gigawatt requires approximately 30 to 40 tons of silver. Do the math. That's 18,000 to 24,000 tons of silver just for the EU's solar build-out over the next 5 years. Global solar installations in 2025 reached 520 gigawatts of new capacity, according to preliminary data from the International Energy Agency. This is a 35% increase over 2024. China installed 280 gigawatts alone. The United States installed 45 gigawatts. India installed 38 gigawatts. Every single one of those panels has silver paste conducting electricity through its cells. And it's not just solar. Electric vehicle production consumed approximately 88 million ounces of silver in 2025, up 22% from the prior year. Tesla alone produced 2.3 million vehicles this year. Each EV uses roughly 25 to 50 grams of silver depending on the model. That's 0.8 to 1.6 ounces per car. Multiply that across the entire EV industry, and you're looking at exponential growth in structural demand. This isn't investment demand that can turn on and off based on sentiment. This is industrial consumption. Once that silver is bonded into a solar panel or soldered into a circuit board, it's gone. It's not coming back. So if demand is exploding and supply is constrained, why did silver drop 3.87% today? Because the paper market and the physical market are diverging, and most people are watching the wrong signal. The spot price is determined by futures trading on exchanges like the COMEX and the London Bullion Market. These are platforms where banks, hedge funds, and high-frequency trading algorithms trade contracts representing silver they don't own and will never touch. The volume is enormous, but it's mostly speculative positioning. When a hedge fund decides to take profit on a long position, or when an algorithm detects a technical breakdown and triggers sell orders, the spot price moves. But that movement has nothing to do with physical supply and demand fundamentals. Meanwhile, in the physical market, premiums are surging. As of this week, if you try to buy a silver eagle from a major online dealer, you're paying spot plus $6 to $8 per ounce. That's a 10 to 13% premium. In October, those premiums were $3 to $4. Why are premiums rising if the price is falling? Because the physical market is tight. Mints are struggling to keep up with demand. The U.S. Mint sold 5.2 million silver eagles in November 2025, the highest monthly sales figure since March 2021. The Perth Mint in Australia reported record sales of silver kangaroos in the second half of 2025. The Royal Canadian Mint is operating at capacity. These institutions buy silver blanks from refineries, and refineries are facing their own challenges. Here's a fact that didn't make headlines. In September 2025, Metalor Technologies, one of Switzerland's largest precious metals refiners, announced a 6-week delay in delivery times for silver products. They cited unprecedented demand and logistical challenges. This wasn't a temporary blip. As of early December, lead times remain elevated. Heraeus, another major refiner, quietly implemented allocation protocols for certain silver products in November. What's an allocation protocol? It means they're rationing. They're telling buyers, we can't give you everything you want right now. You'll get your metal, but you'll have to wait, and you might not get the full quantity you ordered. This is the divergence. The paper price is falling because speculators are selling. The physical premium is rising because actual metal is scarce. If you're watching the spot price and thinking silver is getting cheaper, you're watching the wrong screen. You're looking at the green code, not the reality behind it. Let's go deeper into the mechanics of how this divergence works, because this is where the red pill really kicks in. When a refinery like Heraeus or Metalor buys raw silver, either from a mine or from recycled material, they need to protect themselves against price fluctuations while they process it. Refining takes time, so they hedge by shorting silver futures. This is called a delta-neutral hedge. If the price of silver drops while they're refining, they lose money on the physical metal but make money on their short position. If the price rises, they make money on the physical but lose money on the short. In a normal market, this works perfectly, but December 2025 is not a normal market. When silver spiked to $64.85 on December 11th, refiners who were short silver futures got margin calls. A margin call is when your broker says, "Hey, your position is losing money. Send us more cash to cover potential losses. If you can't send the cash, we'll close your position." For a refinery operating on thin margins, a massive move in silver prices creates a liquidity crisis. They have the physical metal, but it's sitting in a furnace or a vault. It's not liquid. They can't instantly convert it to cash to meet the margin call. What do? They stop taking new orders. They halt production. They wait for volatility to calm down. This is why, paradoxically, a spike in silver prices can actually reduce physical supply in the short term. The higher the price goes, the more violent the moves, the harder it is for refineries to hedge, and the more they pull back. This happened in March 2020 when silver briefly spiked during the COVID panic. It happened in February 2021 during the Reddit silver squeeze attempt. And it's happening now. The refineries aren't broken. The system isn't collapsing. It's just stressed. And when the system is stressed, the players with the most capital and the best information, players like JP Morgan, can exploit the chaos. Here's how it works. JP Morgan holds massive physical silver. They're not worried about refining. They're not worried about hedging. They can sit on their metal and wait. When volatility causes smaller players, retail investors, small dealers, to panic and sell, JP Morgan buys. When volatility causes industrial users to panic and scramble for supply, JP Morgan sells them futures contracts at elevated prices, knowing those contracts will likely be settled in cash, not metal. It's a beautiful arbitrage. They're making money on both sides of the trade while accumulating more physical at advantageous prices. The drop to $62.09 today is not a failure of the silver bull thesis. It's evidence that the thesis is playing out exactly as the big players want it to. Volatility shakes out weak hands. It creates fear. It makes people doubt. And doubt is the enemy of conviction. If you believed silver was going to $100 when it hit $64.85, but now you're questioning that belief at $62.09, you're experiencing exactly what the system is designed to make you feel. Now, let's address the elephant in the room, the weekly chart. From December 6th to December 13th, silver rose 6.15%, from $60.38 to $64.09. That's a significant weekly gain. But here's what nobody's talking about. That rally took silver right into a major resistance zone that's been in place since 2011. On the long-term chart, $65 represents the high from April 2011, just before silver crashed from its all-time peak of $49. Wait, you might be thinking, didn't silver hit $49 in 2011? How is $65 resistance if the all-time high was $49? Because we're talking nominal dollars versus inflation-adjusted dollars. In April 2011, silver peaked at $49.80. Adjusted for inflation to December 2025 dollars, that's approximately $69. So the real all-time high, in purchasing power terms, is around $69. And we just tested the lower end of that resistance zone at $64.85 before pulling back. This is a technical rejection, not a fundamental failure. The market tried to break through a 14-year resistance level, couldn't do it on the first attempt, and is now consolidating. The fact that we're holding above $62 after such a violent move is actually bullish from a technical perspective. It suggests there's strong underlying support. But here's the thing. Technical analysis is just another layer of the matrix. It's a tool that traders use to make sense of price movements, but it doesn't tell you anything about the real-world fundamentals of supply and demand. The real question you should be asking is not, will silver go back to $64.85? The real question is, where is the physical metal going, and who's getting it? Because that's the game. The price on the screen is noise. The flow of metal is signal. And right now, the signal is screaming that physical silver is moving from west to east, from speculators to hoarders, from weak hands to strong hands. China's silver imports in 2025 reached approximately 220 million ounces through November, according to customs data analyzed by metals research firms. That's up 18% from 2024. India imported roughly 185 million ounces, up 12%. These two countries alone imported over 400 million ounces of silver in 2025, nearly half the global mine supply. Where's that metal going? Into jewelry, yes. Into industrial applications, yes. But also into private vaults, into central bank reserves, into the hands of individuals and institutions who view silver as monetary insurance in a world where fiat currencies are being debased at an accelerating rate. And that brings us to the final piece of the puzzle, the dollar. The U.S. dollar index, which measures the dollar against a basket of foreign currencies, has been remarkably stable in 2025, hovering between 104 and 107 for most of the year. But stability in the dollar index masks what's happening beneath the surface. The Federal Reserve's balance sheet stands at approximately $7.4 trillion as of December 2025. That's down from the peak of $9 trillion in early 2022, but it's still more than double the pre-COVID level of $3.7 trillion. The U.S. national debt crossed $36 trillion in November 2025. The deficit for fiscal year 2025 was approximately $1.9 trillion. These are not abstractions. These are the coordinates of monetary debasement. Every dollar of deficit spending is a dollar that dilutes the purchasing power of every existing dollar. And silver, along with gold, is the historical hedge against this debasement. But here's the twist. The mainstream narrative says gold is the monetary metal and silver is the industrial metal. This narrative serves a purpose. It keeps attention focused on gold, which central banks can accumulate and control, while silver remains fragmented, held by millions of small investors and industrial users who don't coordinate. But the reality is that silver has always been money. For most of human history, silver was the common person's money, while gold was the king's money. That ratio reflected the relative scarcity of the metals. Today, the gold-to-silver ratio sits at around 85 to 1, meaning it takes 85 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged 15 to 1. If silver were to return to that historical average, with gold at approximately $5,200 per ounce today, silver would be worth $346 per ounce. Obviously, historical averages don't dictate future prices, but they do reveal how distorted the current relationship is. The point is this. The drop to $62.09 today is not the end of the silver story. It's a chapter in a much longer book. The book is about the transition from a debt-based fiat monetary system to a system where hard assets reassert their role as stores of value. That transition is not going to be smooth. It's going to be volatile, chaotic, and filled with false signals. The matrix doesn't dissolve peacefully. It fights back. It creates illusions. It makes you doubt what you see. So what's the takeaway? If you're watching the silver market, understand that you're watching two markets. The paper market, which is a casino where prices are determined by leverage and speculation, and the physical market, which is a slow-moving glacier of supply and demand fundamentals. The paper price will whip around. It will spike and crash. It will test your emotions and your conviction. But the physical market is relentless. It doesn't care about your feelings. It only cares about ounces. And the ounces are disappearing from the visible market into private hands, into industrial applications, into uses where they will never return to circulation. Today's price of $62.09 is neither victory nor defeat. It's just a data point. What matters is the trend beneath the volatility. And that trend is unmistakable. Demand is rising. Supply is constrained. Inventories are falling. Premiums are widening. These are facts, not predictions. The question is not whether this trend will continue. The question is how long it takes for the paper price to catch up with the physical reality. And when it does, When the divergence becomes undeniable, that's when the real repricing happens. That's when $62 looks cheap. That's when $100 looks inevitable. That's when the red pill fully dissolves and everyone sees the code. We're living through a historic moment in commodity markets. The silver market is revealing in real time how fractional reserve systems break down under stress, how leverage creates the illusion of abundance until someone asks for delivery, how institutions position themselves months ahead of public awareness. This is not financial advice. This is observation. This is pattern recognition. And the pattern says that today's dip is not the story. The story is the structural deficit that cannot be solved by printing contracts. The story is the industrial revolution in green technology that's consuming silver at unprecedented rates. The story is the quiet accumulation by entities who understand that in a world of infinite digital currency, finite physical resources become priceless. The Matrix had a famous scene where Morpheus offers Neo 2 pills. The blue pill returns him to the comfortable illusion. The red pill shows him the truth, no matter how disturbing. Most investors in silver have already taken the red pill. They've seen the manipulation, the paper games, the disconnect between price and value. But here's what the movie didn't tell you. Taking the red pill doesn't mean you immediately win. It means you see the game clearly. And seeing the game clearly means accepting that the price on your screen today, December 14th, 2025, at $62.09, is just another move in a match that's been playing for decades. The players with the most capital, the most information, and the longest time horizon are making their moves right now. The question is whether you can see through the noise and recognize what's actually happening. If you found this analysis valuable, subscribe to stay updated on the silver market's evolution. Leave a comment below with your thoughts on today's price action and where you think this market is heading. The conversation is just beginning, and your perspective matters. Subscribe now and join the discussion.